Welcome back, and thank you for joining me for another expert interview. I'm Bill Powers with MiningStockEducation.com. The topic of today's discussion centers around the coming market crash and what will happen to gold, gold stocks, and the US dollar. With me on the line is Dave Kranzler of Investment Research Dynamics. Dave holds an MBA from the University of Chicago with a concentration in accounting and finance. Over the years, he's worked in various analytic and trading jobs on Wall Street. For 9 of those years, he traded junk bonds for a large bank. For about the past 16 years, Dave has been an avid student of the precious metals markets and a steadfast proponent of holding physical gold and silver in one's portfolio. Currently, he co-manages a precious metals and mining stock investment fund in Denver, and Dave's stated goal is to help people understand and analyze what's really going on in our financial system and economy. So Dave, I appreciate you joining me today to discuss topics that I know you're passionate about.
Oh, well, thanks for having me. It's a pleasure to be here.
If I could, I'd like to begin by getting your response to a recent comment made by a YouTube user on my channel. This YouTube user, John, writes, "Optimism in precious metals and miners is on life support. People are tired of the manipulation. People are tired of the precious metals pushers saying precious metals are going to break out. People are just tired of the whole sector doing nothing." Dave, do you think John is accurately describing a general investor sentiment in this sector? And what would your response be to John?
I think some investors are probably discouraged. I found that with friends and colleagues who jumped into the game, like maybe after 2008, a lot of people didn't even jump into it until gold was headed toward 1900 and silver was headed toward 50. It peaked at 49, and so they're in at a much higher cost basis than investors who have been in it really since the bull market started or who got involved before 2008. So, if you measure the price of gold from kind of when it's considered that the bull market started, which would be probably late 2000, early 2001. You measure the price of gold from then until now, and it's outperformed just about every asset class. I think there might be some kind of oddball commodities that have done better, but in terms of what I would consider mainstream investment vehicles, gold and silver have outperformed everything. So, in terms of the sentiment, I think it kind of depends on how you measure sentiment. I get a 3 times a day report from a guy named John Brimlow, and he's been around forever. And it's a somewhat expensive subscription service. If anyone's interested in it, they can contact him, or they just contact me and I get you the email address. But he doesn't advertise it. It's called Brimlow Gold Jottings at Gmail. And it's really kind of geared more toward institutional type investors. But I think if you're going to be a professional type investor in this sector, I think you have to get his subscription service. But anyway, one of the things that he publishes every day is there's an outfit called Market Vein that measures sentiment for gold and silver, and then everyone's probably, I'm sure all your audience has heard of Mark Holbert. He publishes several different sentiment newsletters or news reports, and one of them is an index that measures the sentiment for that he measures it by looking at gold stock newsletters or newsletters that include recommendations on gold stocks. And the bullish consensus from Market Vein for gold is over 50%. It's 52%. That thing can get I've seen that thing into the 20s and 30s, and I've seen it as high as probably 80%. And I forget how Market Vein measures their sentiment. Silver's at 39%, which is kind of mid-range. So I'd say both gold and silver are kind of mid-range. And I've been getting Brimlow's work for many years, and so in the time that I've been following it, I'd say gold and silver are kind of in the middle of the range, and the Holbert Gold Newsletter Stock Index is at 46%, which means that of all the newsletters that he monitors that make recommendations on gold stocks, there's a 46% long weighting in those, and I've seen, that index can go negative, because that would mean that newsletters who report on gold stocks are actually recommending going short. So it can go well below zero. I think, I want to say in early 2015 maybe, or sometime in 2014, that thing was like minus 45%. And it's been as high as 70 or 80%. And so right now it's when I look at that, I would say, if anything, I'd like to see that index go lower, because that would mean that a lot of the positive sentiment that's still in the mining stocks hasn't been washed out yet from what's happened since gold started heading downhill and the sector started heading, or correcting, I should say, not heading downhill. It's correcting. So I don't really know if you can say that sentiment's negative. I think there's a lot of vocal people who show up in chat boards and other internet venues who are expressing negativity toward it. But when I look at some of the old reliable numbers that I've looked at for a long time, I'd say sentiment's probably bordering a little bit on the positive side.
Okay. What would your response be to his statement, people are tired of the manipulation? You track the COMEX daily. You're well aware of how the precious metals are manipulated. But to the average Joe investor that's frustrated by it, and maybe they have some investments in mining stocks, what would you say to them to give them perspective?
I mean, all markets are manipulated. um, I've learned over the last 16 years to kind of emotionally detach myself from the intervention. I mean, when you understand why they're intervening and how they're intervening, then you can conclude that eventually it's going to fail, and you want to be in this sector when the intervention fails. And when it's going to fail and what's going to be the trigger, no one knows. I don't know. I mean, I stopped forecasting the price of gold probably back in 2009, 2010, putting time frames on my forecasts, because the intervention makes it very difficult, and the central banks, especially the Western central banks, are highly motivated to try and prevent the price of gold from moving higher, especially the Fed, because it's trying to support the dollar's reserve status as the reserve currency. So, I mean, again, I would say, if you just look at gold, I'm not talking about the mining stocks. If you just look at gold's outperformed every single asset class or major asset class since the mid-2000s or early 2001, and I don't know how you can argue against that. I mean, what more can you want from an investment? And also, I'm putting together my mining stock journal that comes out Thursday this week, I was looking at something that was interesting that I hadn't really been paying attention to, but it doesn't surprise me. If you measure the performance of gold from the beginning of this year, year to date, against the S&P, the Dow, and the New York Stock Exchange Composite, so essentially measure it against various measures of the stock market, gold has performed in line with the S&P and the Dow, and it's outperformed the New York Stock Exchange Composite since the beginning of the year. And I think that would probably surprise a lot of people to know that. It doesn't surprise me, but I kind of had thought, with all the press and hoopla that the S&P and the Dow are getting, I would have thought that they had outperformed gold year to date, but they haven't. So, I mean, yes, there's intervention that's going on, and you have to live with it, and you have to learn to live with it. But I mean, at some point down the road, anyone who hangs in there is going to be very amply rewarded, in my opinion.
Dave, I have before me an article that you've written, and the title of it is "A Stock Market Crash, a matter of when, not if. Earlier today, Janet Yellen, the Fed chair, said that another financial crisis is not likely in our lifetime. Contra to her, Jim Rogers, the legendary investor, recently stated with confidence when he was being interviewed by Business Insider that the biggest crash of his lifetime is coming, he said, later this year or 2018. I know that even in the title of your article, you're not putting a time on it, but what do you think of Yellen's statement contrasted with Jim Rogers' statement?
What? I said the stock market's going to crash? I thought stocks only go up. Well, when I saw Yellen's statement earlier today, the first thing that came to mind was when Ben Bernanke made the statement in 2007. In fact, I think it was the middle of 2007 that everything in the mortgage market was fine and the housing market was fine. And we saw what happened about 9 to 12 months after that. So, I mean, these central bank representatives or the Fed heads, whatever, they're basically pre-programmed what to say. I don't think any of them has I think Greenspan probably had original thoughts, and he was actually highly intelligent. But the last couple of them, Bernanke and now Yellen, I think they're just programmed zombies, and they just read what's put in front of them. If you really dig through some of these bank financials, on the surface they look, they're healthier than they were in 2008, but that's just because the accounting rules were changed to allow them to hide their derivative exposure and also allowed them to avoid marking to market some of their riskier debt investments. So we don't really know exactly what type of financial condition these banks are in. But I would suggest that one of the reasons that the Fed is working every day to hold up the stock market is to prevent not only a bloodbath in the pension, in all the pension funds, but to help prevent another bloodbath in the banks. So in terms of what she had to say, I don't think there's any. I think it's just an empty statement that it's just central bank elitist rhetoric. And Jim Rogers, what's surprising about Jim Rogers is that he's come out and he's been very vocal about how the market being overvalued and we're headed for the biggest accident of our lifetime, which I happen to agree with. And what also is interesting is when I first got into this sector, Rogers is a smart guy and he's also really cagey. And he used to talk about investing in silver as a commodity, and he would talk about when he was buying it and when he thought it was overvalued. Well, I think he was kind of talking out of both sides of his mouth. He never mentioned gold, but I have a suspicion because if you watch what he's done with kind of how he's set up over the last, really since the turn of the century. He sold his expensive townhome in New York City. He moved his family to Singapore. I think he's spent the better part of the last 15 to 20 years probably buying a lot of insurance on the wealth that he's accumulated, which is a massive amount. I mean, he's a billionaire. I'm sure he's spent, I'm sure he's moved a lot of that wealth into physical gold and silver that he keeps over in Singapore. And I don't think he really, up until now, he hasn't been vocal about his feelings about gold. So it kind of surprises me. But I also think it means that, if you're going to trust anyone's instinct out there, I think you got to trust him. And if he's out here saying, issuing these warnings, I'd say we're probably a lot closer to a big accident happening in all the markets than we were 3 to 5 years ago.
What's your view on the U.S. dollar's relationship to a stock market crash? Do you think that the downfall of the dollar could trigger a market crash, or do you think the downfall of the dollar would be on the other side of a general equities market crash?
And that's a really good question. And again, I think I kind of throw it into the category of no one really knows how this thing's going to implode, what the trigger is going to be. From time to time, I kind of come to the thinking that they're going to be able to hold this whole thing up until they can't prevent the dollar from collapsing. I mean, if you think about what the dollar's backed with, it's backed by a bunch of debt and empty promises. It's backed by the full faith and credit of the U.S. government. Well, on a debt to GDP basis, the U.S. government is one of the most leveraged in the world. I think maybe China and Japan on a sovereign basis have more debt as a percentage of GDP. But if you add in the total credit market debt, so corporations, households, and the government, the U.S. is more leveraged than any country in the world. So that's what's backing the dollar. It's basically, I mean, it's a debt instrument, and it's backed by rhetoric. It's backed by a printing press, and we saw how well that worked for Weimar Germany. Eventually they kept printing money and using that printed money to pay their debts, and one night people went to bed, and people who were the equivalent of millionaires back then woke up the next day and they were broke. And I think that could happen here. But at any rate, I kind of thought that they're going to be able to hold these markets up until they can't prevent the dollar from collapsing. And what would cause a dollar collapse is when countries like China and their allies, the Shanghai Cooperation Organization or some of those other Eastern Bloc organizations, if those countries just say, no mas, we don't want any more dollars, that's what's going to precipitate a collapse in the dollar. I don't know when that'll happen or if it'll happen, but it's certainly one of the scenarios that could precipitate a serious crash. I think something's going to happen before the rest of the world says no more dollars, thank you. I think what's going to happen is there's going to be some stone tossed onto the proverbial camel's back of our stock market, and it's going to set off an avalanche of hedge fund algorithm HFT selling, and it's going to be more than the Fed can prevent. And I think at some point they'll just have to unplug the markets. We saw that happen a couple of years ago, where all of a sudden the New York Stock Exchange stopped. I don't know if you remember that. I wrote a blog post about it, and I had a pretty funny graphic in there that was titled "Circuit Breaker," and it showed a plug that was unplugged from a wall outlet. And I think that's a very real scenario that could happen. It could happen tomorrow. It could happen sometime in the next 2 years. It could happen sometimes in the next 2 months. I don't know. But I think a scenario like that will occur before the dollar collapses.
When the stock market does turn over, how do you see resource stocks, and in particular gold stocks, performing in relationship to the general equities? You mentioned how the algorithms just hit the bid, they just sell. That's kind of what happened in late 2008, where all the mining stocks tanked about halfway down with the rest of the equities before they then zoomed back up. With the coming expected collapse you see here, how do you expect resource stocks to perform?
That's another really good question, and I don't know that there's any right answer to that question. What I think probably happens is that, at least with the stocks, I think what happens is when these hedge funds, when the sell stops get triggered and all of a sudden they're looking at margin calls, they sell everything that's not nailed down, and that would include any kind of mining stock exposure that they have in their funds. And that might drive down the mining stocks with the market. You're not going to be able to time that. No one can time that. But you definitely want to leave some cash on hand for when it does happen, and then jump in. But and again, you're not going to be able to time the bottom on something like that. What I like to look at as a good example is, I don't know if you remember this, but I think it was May 2010, and there was a day when the Dow started heading lower, and it had dropped about 500 points, and at that point, gold and silver and the mining stocks were getting hammered. And then the Dow kept dropping further. It eventually was down. It was down 1,000 points at one point during the day, really briefly. But when around the time that the Dow started going below, lower than down 500 points, all of a sudden gold and silver caught a flight to safety bid, and they started rallying. And at one point, and again, I don't remember the specific numbers, but gold was up double digits. I want to say over $20. Silver was up even more on a percentage basis, and the mining stocks had rallied and had gone into green territory. So in a scenario where I think we get a steep market sell-off, I think you probably see everything sell off in correlation with that. And then I think you'll see a flight to quality bid come into the market that'll move gold and silver higher, and then the mining stocks will follow those. And that's the best model that I have to answer that question. I mean, other than that, I mean, it's anyone's guess.
That leads me to your own investment philosophy when it comes to mining stocks. You co-manage a precious metals and mining investment fund. Could you share with listeners your investment philosophy with this fund?
Sure. What we do, we became officialized in June of 2008, right before gold and silver really started to get hit. So we funded it with our personal money, and we had just bought a bunch of physical gold and silver, and we had some mining stocks in there, and it took a couple months after that before we started getting some investors into the fund. But what the idea behind the fund is we wanted to create a vehicle that would let investors invest in physical bullion that you can actually take delivery of your pro rata share of the physical bullion when you cash out. We keep it in a depository in Delaware, and then we barbell that with junior mining stocks. So we make longer term investments in junior mining stocks.
Exclusively juniors, no majors or mid-tiers?
Not exclusively. I mean, if I see an opportunity that I think is a short-term opportunity where a larger cap stock gets hit for some reason, I did it a few times with Agnico Eagle. We'll jump in that, but it's more of a short-term thing. I think that the long-term upside, the best long-term upside opportunity in this sector from the stock standpoint is junior mining stocks. Mm-hmm. So, a good example of like not putting, well, I guess a lot of people would consider Sandstorm a junior, but when Sandstorm announced their takeover of Mariana Resources, which happened, and I had no idea it was coming. It literally happened 2 or 3 months after I recommended and featured Mariana in the Mining Stock Journal. So the subscribers who bought that one had a good return on their money. But Sandstorm got hit really hard after that deal was announced, because part of the deal was issuing stock, and it's going to require some capital investment to get Mariana over the finish line into becoming a producer. And so we jumped into Sandstorm shortly after that, because I just looked at it and I said, hey, at some point, this thing's going to rebound and go back to where it was before this nonsense. It also was at a time when stocks were getting caught up in that GDXJ nonsense. So, but we've had a nice, from the time we bought into the stock and through now, we've had a nice return on that chunk of capital that we put into Sandstorm. So I don't really consider Sandstorm a junior per se, even though it's a small cap mining stock. For me, a junior is a company that has a promising property that they've either explored and they've demonstrated mineralization, and there's a lot more goes into it than just that. But it's really more, I would call it more like a venture capital exploration, gold or silver exploration company. That's what I really classify as a true junior, and that's the type of names and ideas that I look for the Mining Stock Journal, and the type of names that we invest in the fund.
Through 2011 through 2015, with gold and silver's downturn, where did you put the fund's money during that extreme downturn, those 5 years?
The three of us jumped into a survival shelter and locked the door above us, and
right.
waited till it was safe to come out. That's the problem with investing in the juniors. And thank God, half the fund was in physical gold and silver, and thank God we were invested in physical gold and silver, because that really saved the fund from being a total disaster. But you can't really turn on the dime and sell a lot of these stocks, because, as you know, they're not. A lot of them aren't super liquid. So if you're running big positions in them and you're swinging for the fence, they're not that easy to get out of. So, and the other thing is, when the market started going down in 2011, I don't think anyone thought that it would ever go as low as it did. And so, you'd look up after a few months and after a particularly brutal downtrend period, and you'd say, can it really go any lower? Well, let's not buy any more stocks, but let's not sell anything. Do you know what I mean? So we just held our nose through the whole thing, and fortunately, we had cash that came in intermittently during that period, and then cash that started coming in from existing investors plus new investors, right around the middle of 2015. So we were able to not necessarily fully double down in some of the positions that were really beat up, but we were able to add to them and lower our cost basis. So, our performance from the fourth quarter of 2015 through the end of the first quarter was, it was lights out. We did really well versus our benchmark and versus the stock market.
Dave, before you go, could you share with the listener, if they're interested in your fund or your mining stock journal or short sellers journal, where would they go and how can they contact you?
Sure. You can take a look at what the short sellers journal and the mining stock journal are all about. I have links on my website, investmentresearchdynamics.com, and the short sellers journal is published every Sunday evening, and the mining stock journal is published every other Thursday evening. So the next issue is coming out Thursday on the mining stock journal. In fact, I've been working on it all day today. In terms of our fund, it's an accredited investor hedge fund type fund. It's not a public fund. It's registered in a few different states, including Colorado, and it's small enough that we don't have to register it with the SEC. And there's a minimum investment, but if anyone's interested in it, they can shoot me an email at dkranzler62@gmail.com. That's the best email to reach me on.
Dave, I appreciate you stopping by and sharing your insights. Thank you very much.
Bill, thanks for having me. It's been a pleasure, and you asked some great questions.
Thank you for listening to this Mining Stock Education podcast. Please subscribe and share with like-minded investors. Visit us on the web at MiningStockEducation.com for more resources on precious metals and natural resource investing. At our website, you can also sign up for our free newsletter for interview transcripts, stock picks, and more.